Okay, good morning. It looks like it is 9 o'clock Eastern, right on the dot, so we will go ahead and get started. Welcome everybody to our Worksheet S-10 audit training. And in this session, we're going to be talking about what we're calling the 2022 audits, which relate to those cost report periods beginning in federal fiscal year 2020. So I know we just wrapped up last year's right around mid-December or so. They were due by 12/31. And now we're getting started on the next round. Had a little bit of a break, a month and a half break, and now we're back into it. So just a quick note. First of all, thank you all for attending, taking the time to attend. The session itself will be recorded, and it'll be posted on our website probably within 3 days, a week, probably more like a week after the session. By that time, it'll be available there, and I'll send the email out as well for everybody. You should have already received the PowerPoints and the template. I sent those out yesterday, and I'll send them all out again in the next email as well. So just a quick overview. We're going to go through the PowerPoint slides themselves. First of all, to start our discussion, that's certainly going to take the majority of the time. But then toward the end, I wanted to open up the actual template that you've already received. It's very similar to last year. There were just a few tweaks to the questionnaire, but we'll go through that, talk about it, see if there are any questions, and of course we'll have available time for questions at the end. So we'll go through a quick overview and time frames, some upcoming, really not a discussion of the changes, but just information on potential changes for next year to the cost reporting templates and instructions. We'll go through the cost reporting instructions themselves, talk about the charity care policy. As I said, we'll spend time with the templates. We will talk a little about the portal, the secure portal that's used. It's File Exchange. It used to be known as Secure EDI. We'll talk about some special points about each of the three items: charity care, payment, and bad debts. A lot of them will be reminders of things we've already covered early on. And then just a slide talking about available resources. And as I mentioned, we'll have plenty of time for questions. So quick overview and time frames. Last year we dealt with those cost report periods beginning in federal fiscal year 19. They were due by December 31st of last year. Now, of course, we don't know exactly for sure what CMS is going to use that data for yet. We'll find out in the next couple of months when they propose it. Sometime in April or May, whenever we get the proposed rule. And then the current year, I said we're doing the fiscal year 20 audits. Again, we won't know exactly what they're going to use that for until they issue the April-May 23 proposed rule. Now, I will mention that so far on the 4th, we sent out the information request letters for the fiscal years all the way through 4/30/21. So basically 9/30/21, or really September of 20 through the April of 21 fiscal year ends, or March of 21 fiscal year ends. The April through August 21, those ones are going to go out in early March, so in the next couple of weeks. We've broken up into two groups this time. And what you'll see, the letter, we'll open up the letter and talk about it if you haven't already seen it. But the letter basically says, here's the information we're requesting up front. Here are the templates to use. And it says you'll be contacted by the assigned auditor for your review in the near future in order to set up the Secure EDI, the File Exchange connection, so that you can send that information into them. And this is the third year that is covering all hospitals that have reported DISH. We had a couple of years prior to that where it was just a sample of providers based on CMS selection. This is the third year. Again, any hospital that has reported DISH on E-Part A, line 34. Now, the thing is, this does include, the question has come up quite a bit in the past, whether this includes SCH and MDH providers that may not actually being paid on the federal rate. And the answer from CMS is yes, it does. And I have a couple of slides with the excerpt from the Federal Register where CMS is very clear about that. So even if your hospital-specific rate is higher than the federal rate, and it really doesn't matter to you what the dish is because you're getting paid a higher rate anyways, we still are required to audit the S-10 data. So that is included there. Now, the cost reporting instructions, they changed for periods 10/1/16 and after, but they've been the same without change since then. So the past 3 years that we've been doing all these audits, they have stayed the same. There is the potential, a pretty good potential, for them to be changing in the next transmittal of the cost report instructions, and we'll see that in just a bit. But we don't know exactly what's going to change. They had a public comment period about a year ago, and we've been waiting for either a final or another public comment period. From what we've heard, there were so many comments that they're revising it a bit, and they're going to send out another public comment period in the near future. So I'm kind of jumping ahead there. But the point I wanted to make is that the cost reporting instructions are the same. The audit process, for the most part, is the same. Of course, we learn things over the years, so there are some things that are going to be done just due to what we've learned in the past or things we found in the past, just like any other audit. The point I wanted to make here is that CMS really intentionally didn't want any of these changes. They don't want us to change really the level that we're scoping at. They wanted us to make sure that all providers are going through a consistent audit. And the reason is that they wanted 3 good years of audited data so they can take a look at any trends. They can take a look at just the findings in general before they make a decision about possibly going back to something like a 2 or 3 year average of data rather than just 1 year being used for the factor 3. It's possible in the future, depending on what they found, as they start to get more comfortable with both the provider and auditor understanding of the data, they might be comfortable enough to allow for more of a scoped approach in the future, but that's a little bit of speculation until they issue the proposal and final rule. So that would, I would be surprised if they scope it and say that some providers won't be audited at all. I think it's more going to be that some providers that have lower dollar amounts may be audited at a lower level, and other providers that have higher dollar amounts will be audited maybe every single step of the audit program, for example. But again, that's pure speculation at this point. But they want to get comfortable with the data. That's the point I wanted to make. This is just the screenshot from the Federal Register where they first discussed the fact that even sole community hospitals and Medicare dependent hospitals are still subject to the S-10. We don't need to read through the whole paragraph, but it's the 9/18/20 Federal Register if you're interested. And here's the key thing. The response was that all hospitals are required to maintain the documentation, and yeah, so basically they're using the data, they're calculating it for all hospitals. They make some exceptions for the IHS and tribal hospitals in Puerto Rico, which they're treated separately. They're handled separately. Now, here is one thing I do want to mention. The whole point here is to get a rate that's going to be used for future payment. And again, the data itself, the national data, is important because every hospital gets a share of that national pool. So they need accurate data nationally in order to get an accurate share per hospital. But what they did tell us is that if you have a termed hospital, a provider that's not going to be participating on the acute care side when these payments are issued, then it does not make sense to audit their data because they don't want that data in the pool, and obviously that hospital is not going to get a share because they're no longer an acute care hospital. So any acute care hospital that is termed will be pulled out of the pool, and if we already know about it, we've already removed them from the list, but if the hospital terminates mid-audit, then we would cease the audit at that point as well. And this does include converting to a critical access hospital as well. One of the questions that's come up a few times is whether or not cause even have to complete the worksheet. And the interesting thing is the instructions still say that cause do have to complete the worksheet, but it's not currently audited. There's nothing that we're aware of that is done with the data. CMS may be analyzing it for other purposes, but there's no payment we are aware of right now that the cause used this data for. So historically, we used to use this data for the high-tech payment, the EHR payment. That's been gone for a while now. And the big thing is factor 3 of the DISH uncompensated care payment. That's the hospital-specific share of the payment. We'll just briefly see factor 1 is the pool of DISH payments, the national pool. It's essentially the 75% of the original DISH that's been carved out, and now it's being paid out as UCP. Factor 2 is an expected reduction factor that's evaluated and analyzed each year because of the assumption that the number of uninsured patients should be dropping over time. And factor 3, of course, is the big one for us. It's the hospital-specific share. That's what the audit is all about. So what I have here is just a history of the different rates, the estimated DISH payments, and then, of course, this is going to be multiplied by the 75% to get the amount used for the UCP. And we'll see the other part of that in just a bit, the actual factor 2, so what the ultimate amount that's paid out is. We'll see that in just a couple of seconds here, a couple slides. One of the things we always have wanted to do through these webinars and any communication we have is take a look at the different lessons that we've learned across the audits. With S-10, this is still relatively new. We've only been doing it for 5 years total, 3 years for all providers. So it's one of those things that grows over time. You learn more things, both from the provider and the auditor side, and even the CMS side, really. So you identify issues that you may not have been aware of early on. So we're still in that early stage, and we just wanted to communicate these things. One of the issues that has come up, that a lot of these things have been alleviated now, but the format of the listings we're getting to audit, there have been some concerns about the number of requested data fields. Do we really need all of that data? I will tell you, CMS is looking in the next draft, they're looking to eliminate at least a few of those fields that maybe aren't as important as they once thought they were. We don't know what the final version will look like. But for example, the revenue codes, there was a big concern about making sure providers had excluded the professional services from their listing, and that's really the main purpose of the revenue code. They're starting to get away from that. The thought is that maybe for the next round down the road, we might not need to worry about that unless we come across in our sample that, hey, there was a professional service here, then we might have to revise the scope to dig into that issue. So another thing that came up was gender. What is the purpose of having that field on the listing? Very little purpose. It doesn't really serve much of a purpose. We're not looking for certain types of services that may only be for one gender or the other. That's just an odd field to have on there. Those are the two big ones. Missing data elements, certainly. The important ones, other than those two that I just mentioned, we really need that data to be able to audit that claim, that charity care claim. One of the concerns, especially before we moved over to the secure EDI portal at the time, was the size of the files that come from, especially having all those revenue codes, having 10 or more lines per claim. That makes some very large Excel files. And transmitting it now shouldn't be an issue because the secure EDI on the file exchange allow up to 2 gigabytes. And the other issue here was, which most of this has been resolved now, but the issue of query logic. This is something CMS wanted us to look into, and we weren't looking for programming scripts, which when you think of query logic, depending on who you give it to at your facility, they might be responding with their programming scripts, how they actually queried the database to get the information. We're looking more for a narrative that we can understand, we can read through, we can see if there's any risk there. And some timeline obstacles, these have gotten better over time. First of all, one of the things we talked about was because the 12/31, by the way, is a drop dead date at this point. The end of the calendar year is when CMS needs the data so they can begin their analysis for the proposed rule. So that's pretty much locked in. And initially, we weren't starting these things until around March. Last year, we got our letters out a little bit earlier. And this year we've got them out even earlier for the first batch of providers. We started those on February 4th. So the idea here was we needed an earlier start, which would put less pressure on all parties, providers and auditors, so that, if you have the same workload, try to spread it out over a longer time, basically. CMS has given us, they've told us what HICRA states are being used for rulemaking, and they did extend that a little bit. For the proposed rule, they take the December run, which of course is not fully finalized necessarily. But for the final rule, they grab the March run. So if they come across any aberrances in the data, they can get back with us. If we need to re-HICRAS it and resubmit the data, they have until March to get that good data to begin their final rule. Now, again, that doesn't happen often. Most of the stuff they expect to be done by December. There are just a very few that trickle through that they realize something wrong has been submitted. Another obstacle for everybody, all parties involved, because these are acute care hospitals, and acute care hospitals also have wage index reviews to worry about, as well as their standard cost report submissions. So there's that overlap. But again, since these S-10s are now taking the entire year, there's obviously no way around that. They're going to overlap something. What I can tell you is that we gave a proposed due date, or I guess we gave an initial due date of March 4th for the letters we just sent out. Now, I know some of those fiscal years have cost report filings that are right around that date as well, or they're working on the cost report. So if you need an extension for one of those reasons, you can certainly send either me or your auditor that you're assigned to when you find out about it. You can send them an email and we can add in another 2-3 weeks, something like that, to help out. And a big lesson, this is one that's, I guess, relatively new that's coming up that CMS is really starting to stress. The idea of upfront analysis of the listing and trying to get the best, cleanest listing possible by the time we start the detailed testing, the sampling, that versus back-end extrapolation of errors. In a perfect world, we'd be able to find all the errors up front, and then the sample would just affirm that those were correct. They'd give us the assurance that the data was correct. But the problem is we do spend a large amount of work up front trying to look at the listing, see if there are any obvious and pervasive errors that we can take care of right away. One example is simply if we find professional fees, the revenue codes for professional fees, we know those all need to be pulled out. Hopefully we don't come across those situations. If we find something written off outside of the period, that's an easy fix. If we find obvious duplicates, we can pull those out right away. We'd much rather eliminate those throughout the entire population instead of letting some trickle through as errors in our sample and then having that extrapolated. Now, I will say quantitatively, because within the assigned sampling risk, within the allowed sampling risk, extrapolating gets you a reasonably assured listing, but it's one of those things that quantitatively it's correct, but when you look at kind of qualitatively or just more of a gut feeling, it just doesn't seem right. So that's why we'd rather have as many of those errors caught up front so that we hopefully don't have any or have very few sample errors to extrapolate. But the big thing here is that this is dependent upon really two different things. First of all, both the provider understanding of what the requirements are and the auditor understanding of what that listing was, how the provider gathered the data. That's where that whole query logic comes into play. So that's really our goal with that query logic questionnaire, is to, first of all, it kind of serves as a training as you're going through your listing. It'll point out certain things that you need to be aware of when you're preparing the listing. And then the auditor, when they review it, they'll be able to get some assurance that, yes, you understood what those requirements were, and here's how you made sure to incorporate the requirements into your data. So that's the purpose of that. But, you know, that's not saying, there are some errors that can be found up front. But there are some errors that there's no, for example, if the data itself was wrong on the listing, if you had an incorrect date, if you had an incorrect revenue code typed in or an incorrect dollar amount, there's absolutely no way up front we're going to be able to find that through our upfront review. We can only scan the listing and filter the listing based on the data. So the actual accuracy of the data can only be found through a sample test, and therefore it's going to be subject to extrapolation. Let's see, we have a couple of questions here. One of the questions is whether or not COVID will somehow be factored in the S-10 and the allocation of the UCP. And, you know, that's a very good question that we've actually considered ourselves. We wonder about that, just because the years, especially, let's see, we're doing, I mean, really every year we're doing right now, 9/30/20 fiscal year ends through 8/30/21 fiscal year ends. Every single one of those years is impacted, all or most of the months, by COVID. In other words, the wild fluctuations, the variations in hospital utilization and the types of utilization, and of course just charity care in general. So you do bring up a good point. We don't have an answer for that. We haven't heard from CMS, but I wouldn't be a bit surprised if now they mention that in the proposed rule, or at the very least if there are going to be some comments from the proposed rule that make it into the final rule. It'll be really interesting to see what they say about that. You know, one of the thoughts, because the question came up, will they try to average this? Even though they said they wanted to wait to average, will they try to average this across a couple of years? Or, you know, who knows, possibly they may feel the pressure. They may decide to jump back to an earlier year to use that data. I don't know. That's a good question, but we just don't have a final answer for that one. We haven't really heard much from them on it. Very good question, though. And the other question is, in regards to extrapolation, can we provide how the calculation or formula is? For example, do we take the error amount divided by the sampled amount, or by the number of errored accounts, divided by the total? Yeah, it's the amount itself. In fact, what we have, we're looking for, I can share this. It's pretty, there are only a few, well, I shouldn't say a few, but there are a few different types of samples. We use variables sampling because it's based on dollar amounts. So with the system we use, it does take into consideration, you know, we take a look at a confidence interval, a precision level, and we determine what the required sample size is going to be, first of all. And then we do have to validate the sample. We can't just, if it told us we needed 10 or 15 or 20 or whatever, we can't just take that and then whatever errors we find, we extrapolate. We have to validate the sample by taking a look at the amended or audited listing after accounting for those errors, and we plug it back into the system to see if it still meets those required confidence and precision intervals to be a valid sample. If it does, then we can extrapolate, and it is a dollar amount comparison. It's the dollar amount that gets extrapolated. So it's it very well could just be one, you know, let's say there are 10 or 15 or 20 units. There might have been 1 or 2 units that had major errors to them, and the other 8 were fine. or whatever the remaining number is, but it would be the dollar amounts that gets extrapolated. So one MAC would take only the number of counts, not the dollar amount. So that is, that'd be a little bit concerning. So if they're saying if 2 of the 10, let's say 10 accounts were in error, they assume 20% of the entire population's in error. Yeah, I'm not aware of any. That would work under attribute sampling, where every single unit's the exact same, but that just really wouldn't work under any sort of variable sampling where you're dealing with dollar amounts. So that is concerning if they're extrapolating based on that. I will say this is something, in fact, I have another slide. Actually, it's the absolute next slide that kind of touches on that. One of the other concerns or the lessons learned from CMS and from MACs was the concern about inconsistent sampling. Now, I will mention that we do have MAC work groups where we talk about a lot of these issues to try to become more consistent, try to make sure issues are brought up to everybody. So that's certainly something we could talk about as well. There's one of the work groups in the near future is going to be talking about things like sampling and sample sizes, things like that, but certainly not the first time we've had that discussion. CMS has not mandated a particular methodology, but the one you're mentioning does seem a little odd that without knowing the details, just knowing that they're looking at the number of accounts, that shouldn't work unless every account was exactly the same, which is extremely unlikely. So methodology, sample sizes, extrapolation, and the big thing we're going to be talking about in this upcoming meeting is when we get to sampling, what type of supporting documentation are we requesting and looking at? How deeply do we need to dig? So those are all sampling type issues. Communication breakdowns, that's another thing that there's always a concern about. We think it's gotten better. We have a listing where as soon as we identify, as soon as the auditor is assigned to you, they make sure as part of the insurance conference that they have the proper points of contact, and then we log it. We have that log, and that's actually what we go off of for the next year's letters. And like this year when I sent them out on February 4th, the first thing I mentioned was, please let me know if there are any corrections. And we've certainly had quite a few corrections. You know, people leave, people retire, new people come in, they get reassigned, whatever. So we update the listing, and that way the auditor then knows who the proper person is. So our goal is up front to try to get that straightened out so there's not a situation where an email is sent, a request, and it's just sitting there because it wasn't sent to the right person. You know, we do have multiple auditors. I think what this was talking about was within the chain. You know, we have all of our field audit staff handling the S-10 audits, and some of the chains that are bigger, there's certainly no way there's 1 or even 2 or 3 auditors that could take care of that entire chain. When we're assigning the audits, we do try to take that stuff into consideration to mitigate it to some extent. We don't want to have, you know, every single provider within a chain done by a completely different person. That would just be inefficient. So we try to block it as much as we can. And another thing that's come up was the concern about insufficient time to review or respond to adjustments. And CMS does mandate that we give a 2-week period for the adjustments, but the hope is that as the auditor has been going through and finding issues, hopefully they're communicating that along the way. Some of the issues won't be known until the very end, but you should be having communication with them throughout as they come across concerns. And then the education and training opportunities. The whole idea here is to try to make sure everybody's aware of some of the issues that are coming up and all of that. We have webinars, we have the website. Oh yeah, and Jane, that's a good point there. That was just brought up last week. It looks like the mail merge for the last, I think the 45 through 50s provider numbers, somehow they got off by 1 basically. So the provider name and the provider number didn't match for those last probably a dozen or so providers. I did send out revisions to those just yesterday and the day before. So those providers that were impacted, again, it was about 12, 15, something like that. They received a revision to that one. So, and let's see. So here's what I was mentioning earlier. Transmittal 18 of the cost reporting instructions, the hospital cost reporting instructions. This is not out yet. They're working on a draft, but they did publish Transmittal 17 most recently, January 10th, and this is going to be effective for cost reporting periods beginning. Actually, it should be ending on or after 12/31/21. And the point here was that in this Transmittal 17, we thought they were going to have, well, initially we thought they were going to have some of these changes incorporated, but since they took a long time to work on the public comment for the different templates, what they called the Paperwork Reduction Act, the PRA, they developed some templates, they sent them out for public comment, and there were a lot of public comments, as I mentioned earlier. So it didn't make it into Transmittal 17, and therefore it's not going to impact this year's audits. We're still going to stick with the same templates that we had in the past, but it's very likely that by next year we'll have different templates. The other question, as far as the letters, so we sent out the hard copy first, and then I followed up with an email copy to the contacts that we are aware of from the log. By requirement of CMS, we have to send these types of requests out to the facility at the very minimum, but then I followed up to our specific contacts that we know about from the log. So, Jane, so again, that kind of just what I said, we're required to send a request out to the facility, and we don't have everybody's email address, unfortunately. Every facility doesn't have an email address to their main contact, so we won't be able to get away from physically mailing them. And yeah, the email, so the thing with the email though, just the way it was, I had to manually go in and do it, so that obviously takes a little bit of time there. That's what caused that. It was pretty quick to mail merge. We have a mail center that can do the physical mailing, but for email, it's one by one manually grabbing the contacts from our log. So that's what took a little bit of time there. And I think, yeah, it was like an extra 4 days. I think the 4th was when they went out by mail, and they started going out around the 8th or so, 9th by email. And let's see. So now, another thing I just wanted to mention here was we have, and this is something we had last year as well, we have an audit feedback email address. This is for a lot of things other than just S-10, but we have this audit feedback email address where feel free to share any comments or any feedback with a particular audit or desk review or acceptability. There's the email address to use, and we can use that for S-10 audits as well. Here's the information I had. Now, the first slide that I sent out actually only had the proposed data. This is updated for the finalized data. It was in the same Federal Register just later on, about a page later. So this is the total amount that's being spread across all hospitals. So 7.1 billion there. And again, factor 3 is what determines each hospital's share of the pool. That's what our S-10 audits is all about. As I said, we're in the second set of cost reporting instructions for S-10. We've been there for a few years. These are the ones that are effective for cost report periods beginning on or after 10/1/16. I'm not going to spend nearly as much time as I have in the past talking about the old instructions because we're far enough removed from them. There hopefully won't be any confusion, but it did certainly impact the line 22 this should be 20 and 22, line 20 charity care and 22 payments, and then the 26 bad debts. It impacted those. And we do expect some other changes to be coming. And again, I put X's here because we don't know when the fiscal years or what fiscal years are going to be impacted by that T18 change. Just a quick shot of the fact that we had before and after 10.1.16. You always want to make sure, I wish they would have done something better, like bold it or make it even clearer rather than just the underline, but just follow the rules for on or after 10.1.16. Just a summary at the very end, line 30 of worksheet S-10. This is the ultimate number that's going to be used to determine that factor 3. So essentially every hospital, their line 30 is added together to get the total amount of charity care, and then each individual hospital, that their amount is divided by that total amount to get their share of it. That's what the factor 3 essentially is. So factor 3, as it says right here, it's line 23, which is the cost of charity care, plus line 29, which is your bad debt cost. That's where it pulls the amount from. Now, of course, neither of those numbers are input, but you can see it's separated. Charity care and bad debts come together. So now we're going to start digging into the individual pieces. And then we'll talk about just some important parts of the instructions, but then we're going to spend a lot of time on the template itself, because I know we've covered some of this in the past. Line 20 is charity care and uninsured discount if it's in your policy. Right now it's for the entire facility. One of the big proposals in the proposed rule that we've been waiting on is they've proposed to change this to be just for the hospital. Since the payment itself is just for the hospital, they say, why are we including other units that really don't have any dish? They wouldn't have any dish to begin with, so why give them uncompensated care? So that's a proposed change. We don't know if it'll be finalized. Right now it's for the entire facility. And the big important thing here is understanding the difference between these two columns. Column 1 is uninsured, which by its nature, this should be a charge-based number. And as such, it's going to be reduced by a cost-to-charge ratio, because ultimately we want cost. We're trying to determine the cost of the charity care, not the foregone charge or the foregone revenue. So you'll see here, by the time we get from 20 down to the ultimate cost of charity care, this nearly $2 million has dropped down to about $650,000 due to the cost-charge ratio. So column 1 gets reduced. Column 2, for the most part, is supposed to be it's an insured patient, so it's a co-insurance deductible or co-pay. So for the most part, it's going to be not reduced by a cost-to-charge ratio. However, there's one little exception I'll talk about in just a bit, where this amount might include a lot of insured co-insurance and deductible and co-payments, but it may also include some charges for a portion of the stay that wasn't covered by Medicaid because they exceeded the Medicaid length of stay limit. So I'll get to that piece in just a bit. In fact, that's down on line 25 is where they report it. But the other thing is that in either case, either of these numbers, after you reduce it or don't reduce it by the cost to charge ratio, you're going to be offsetting payments on line 22. And that's an important number to understand, because it's not just any and all payments. It's only payments that the patient made for amounts that were previously written off as charity care in a prior year. That's the key thing. So if in 1 year they had charity care for $100,000, that one patient, or $20,000, whatever the amount is, let's say they ended up paying half of it. They came into some money, or they just wanted to take care of that charity care even though it was written off. If they pay that amount, then in the year that they pay it, which would be the next year, that's going to be reducing the cost of the charity care. The thing is, this is not just any patient payment, because they very well may have a portion of that claim that they were responsible for anyways. That payment does not get reported here. That's not charity care at all. That's just their normal payment against their normal bill. So that's the key thing. This is just a payment that a patient made for a prior charity care amount. By its very nature, this should be relatively rare. We've heard of some hospitals that have policies where they're required to return any payments for an amount that was already written off as charity care. Others might accept it, and then they just offset the charity care with it. And just by the nature of it, it's somewhat rare. If the patient received a write-off, it's not a bad debt. It was a write-off against charity care. They no longer owe the money at that point. It's not like a normal bad debt where they technically still owe the money. A charity care is an offset of their bill. So it's very rare. We do want to make sure that number is right, so you're not reducing yourself further than you need to, basically. The other point I was talking about, though, kind of jumping ahead a bit here, this line 25, the current mechanism CMS built in, which we've proposed they change this to clean it up in the future, but we don't know if it'll happen. But basically, if you have any insured patients that were insured by Medicaid, and they have some or even all of their claim, their stay, that exceeded the length of stay limit for that Medicaid program, then at that point, there's no longer a deductible, co-insurance, copay. It's really non-covered. Even though they were insured, it's non-covered. So for this one situation, Medicaid length of stay limit, you're supposed to report the charge here, and that charge is also supposed to be part of line 20, column 2, which is a number that normally is a deductible and co-insurance number, but in this case, it would also be mixed in with that particular charge. The fact that it's reported here as well allows the system to determine how much of this number needs to be reduced by the cost to charge ratio. If this is 0, then this entire amount is assumed to be a deductible and co-insurance, and none of it is reduced by the cost to charge ratio. Here's the other thing I wanted to mention about this, and I know I have a couple slides later, and I think this gets to your question, Nick, as well. For any other non-covered situation other than that length of stay Medicaid limit, any other situation where the patient has exhausted their benefits or a particular service is non-covered, but they are still an insured patient, in that situation, it needs to be reported as uninsured. So the thing is, let's say you have an exhausted benefit where they had a claim and part of the stay was covered, but then midway through they exhausted their benefits. The portion that's covered, so we're talking one claim here, the portion that's covered would have the co-insurance and deductible reported in column 2. The other half of the claim that's not covered would have its charge amount reported in column 1. That's a cleaner way of doing it than this messy line 25 deal for this Medicaid length of stay limit. And that's basically what we proposed to CMS, that they do away with this line 25 and just handle the claims being split that way. Or they could even go into more detail and have multiple subscripts of line 20 to address those situations individually if they felt the need to. But we think it'd be easy just to split the claim. Right now, that's how you have to do it for everything except for this length of stay limit. So, yeah, you're exactly right, Nick. For the Medicaid or any other exhausted benefit, it could be a regular insurance company that has exhausted benefits. Should they be strictly stratified from line 20, column 2, since they don't represent co-insurance and deductible? Oh, so you're talking exhausted length of stay. So are you going back to that? Yeah, if you're going back to that length of stay limit, it needs to be in both places. The way they stratify it is essentially by having the amount in line 25. It also has to be in column 2, line 20. But the fact that it's in line 25 allows us to know how much of this total amount is length of stay. But if it's other exhausted benefits, it just gets split between the two. So again, it's a messy, I don't know why they built it that way. It's really messy, but that's what we have to deal with for right now. Insured with a very low per diem payment. Is this insured? Yeah, I mean, if they have, that'd be more like underinsured almost, but it's still considered an insured patient because there should be some sort of, if it's an insured, there should be some sort of coinsurance deductible or copay. In fact, if there's not, those are the only three things that have been allowable. Initially, they started with coinsurance and deductible. Then they expanded it to copay as well. So it has to have one of those things to be included in the insured column, but that would be where it belongs there. Now, again, if there's a portion of the claim that's not covered or a portion of the stay that's not, if they exhausted the benefits, that portion of the claim, it doesn't have a deductible, coinsurance, or copay, that gets moved over to uninsured. Let's see, so $2,000 payment out of $30,000 charges. So I guess the question would be, is that $28,000 really a deductible, coinsurance, or copay? It sounds like probably most of it would be deductible, I'd imagine. So in that case, yeah, it would be insured, the $28,000, but it would have to be clearly labeled as deductible, coinsurance, or copay, something like that. Oh, and then, yeah, Nick, your question, if you're saying stratified on the listing so that we can sample it properly, there's actually already on the listing, there's a column, it's the very last column that addresses that particular length of stay situation. So we'd be able to stratify it ourselves, or you could stratify it as long as that column's filled out. If you wanted to send us two different parts of the listing, that'd be fine. But since that field exists, we can stratify it just the same as we would stratify maybe high and low dollar amounts or different types of claims that have different risks. So we can stratify it that way. Now 26 is one that has a little bit of confusion to it. 26, there's only one column to it. There's no such thing in this case as uninsured or insured. It's a moot point. But it does include Medicare and non-Medicare bad debts, and both of them are net of any recoveries. If you had recoveries, they should have already been removed. So a couple of things. It's Medicare and non-Medicare. The other thing I want to point out that I wish CMS changed a long time ago, they say total bad debt expense. That's a misnomer. It is absolutely not an expense. It's a write-off. And for virtually all hospitals that have to follow GAAP, the write-off is different from the expense, unless you're using the direct write-off method, which, again, is extremely rare under GAAP. It's usually not allowed. So we don't want to see the bad debt expense from your financial statements. That's virtually never going to be the proper number. It's the amount of write-offs. If you dig into line 26's instruction, it makes it clear that it's a write-off. Specifically, we're looking for, again, both Medicare and non-Medicare that have been written off of your general ledger, your accounts receivable subsidiary ledgers during that period. The key thing with that is that here we're talking financial statements, we're talking GAAP, we're not necessarily talking about Medicare rules of bad debts. We all know that there are a lot of different rules that apply to Medicare before it's allowable for Medicare reimbursement. You can have a bad debt written off of your accounts receivable, and maybe it's still at the collection agency. You've already written it off internally, but maybe it's still at the collection agency. Maybe you were waiting for a Medicaid remittance advice. There might be a lot of things that happen after the actual accounts receivable write-off. We need the accounts receivable write-off date for this number. So there might still be things that have not yet been reported on E-Part A, and they will be in the next period, and that's fine. The unfortunate part about this, and there have been a lot of discussions with CMS and other MACs on this, it was designed in a messy way because it's a little bit inconsistent, and it doesn't really work. there's inconsistencies in the instructions or contradictions in the instructions. But the point is, this 26 has to be write-offs against AR, regardless of whether they're written off for Medicare yet. And down here, 27 and 27.01, these numbers flow from E-Part A, E-Part B, all of the other Medicare reimbursable bad debt numbers. In a perfect world, there would be a matchup as far as periods between when something was written off for Medicare and when something was written off for GAAP, but there's not. There's often a delay before it's written off for Medicare, before it's reported on E-Part A. So the way the calculation works, over any 1 year period, it may seem like a mismatch, but over a 2 year period or 3 year period, it all works itself out, and the bad debts are all included in both places. Now, what I mean by that is that the reason we had to bring in Medicare numbers right here, even though they should have already been included, or most of them at least, should have already been included in line 26, the reason we have to bring in the Medicare here is to give the cost report an idea of how much of this 2.8 million was non-Medicare. So the idea is 2.8 million, and hey, apparently 1.2 million was already reported in total on E-Part A, for example. So that tells us that there must be about 1.6 million of non-Medicare bad debt expense. The reason we need to know the non-Medicare bad debt expense number is that this is multiplied by the cost to charge ratio, similar to the charity care. And in this case, that's, so it's behind the scenes. There's not even a line for it. But this number is multiplied by the cost to charge ratio, and it's added to this, actually the 35%, the amount that was not reimbursed by Medicare. It's that cost of the non-Medicare is added to the 35% of Medicare to get this line 29. So it's kind of unfortunate they didn't add a couple more subscripts for transparency, but there are some behind the scenes calculations going on there. So as you can see right away, there's that bit of mismatch where I just said that line 26, it's all about AR write-offs, but then they're using a Medicare amount to back into a non-Medicare portion. And as you can tell, if this number, let's say this number had a lot of bad debts written off for Medicare, or written off for Medicare patients, but had not yet been written off on E-Part A, then there's going to be that mismatch here. Now, come next year, it'll very likely reverse itself, and you're just going to have a continuously floating number. But unfortunately, until they revise the instructions or revise the calculation, that's kind of what we have to deal with there. So that's what we have for 26, and I just went through this last piece of it. So now, let me see what questions we have here. First of all, are we auditing the insured or uninsured column of the template related to line 26? It's time consuming to fill this out and doesn't impact the calculation. You bring up a good point. I think what our main focus is determining whether or not it's a real bad debt, a legitimate bad debt. So the reason we know whether it's insured, if we know it's insured, then we know that bad debt has to be a deductible or co-insurance. So that's what we would be looking for at that point. We also know that compared to the uninsured, chances are that number should be quite a bit less because, first of all, the amount the patient owed was less. And again, it's an insured patient. Maybe they're more likely to pay. Not necessarily, but maybe that's the risk there. If it's an uninsured patient, it's going to be a full charge amount, and there might be that concern that it's a higher amount. So that's one of the reasons we have the uninsured and insured column there. It's just risk analysis. If it was wrong, I mean, it's obviously it wouldn't lead to an error per se. It just helps us when we scope it, when we assess risk. So hopefully that helps to clarify that piece. And, you know, some of this we can find out, by the way, because they're the primary and secondary payers. Of course, if you have an insurance company listed in your primary payer or either your payers, then we can assume that, hey, it's an insured patient at that point. And let's see, as far as contacts, so yeah, the contacts, they're working on assigning the rest of the units out and getting the actual contact there. I believe this should be done within the next week or so, and then they'll email their information out to you so you can send it back to them. And let's see, a non-Medicare bad debt, what if it relates to a deductible or co-insurance? And you make a very good point here, and that's an argument that was actually made in, I think, if it wasn't last year, it was the year before. There was a public comment that said this whole idea, let me go back to that slide, this whole idea of only subjecting, or basically subjecting all non-Medicare bad debt expense to the cost charge ratio and not subjecting Medicare to the cost charge ratio, it's almost based on an assumption that non-Medicare is a charge amount, which, as you just said, quite a few of them won't be. They're regular patients or regular insured patients. So why are we subjecting a co-insurance and deductible to a cost charge ratio? That question was brought up, and we even had, I think, some providers or some consultants, whatever, tried to build their own little calculation to kind of get around that. And CMS quickly responded that no, everybody has to follow these instructions. They admit that it seems, the calculation seems odd, but basically the response was that's what the rule is right now, and to make sure that everybody's playing on a level playing field, we all have to make sure we audit it that way. I wouldn't be a bit surprised, though, if down the road they change that. That's something I would love to see in the next transmittal if they address that. But again, to do that, you'd have to build in now an uninsured and an insured column. That'd be the only way to do it. But I think that would give us much more accurate numbers for sure. Exactly. Yep. You're right on there, Tom. So hopefully they do that to get around that trouble. And let's see here. So now let's get into some of the data that we need to see in the templates. I think I've talked plenty about column 1, that it includes obviously the fully uninsured patients, but it also includes non-covered services for an otherwise insured patient. The key thing with all of those, though, is it has to be in your policy before you can allow it. CMS has been pretty lenient. Unlike with the bad debt rules, the Medicare bad debt rules, they have very specific requirements, whether it be an indigent patient or whoever. They have policies in place. As far as the charity care, the only policy is that the provider has to have a policy. Now, there's certain things that they flat out disallow, professional fees, courtesy discounts, things like that. But as far as the true charity, they basically say, as long as it's in your policy and you followed your policy, it's allowable here. And we talk, if the insurance company doesn't have a contractual relationship with the provider, for all intents and purposes, that's considered an uninsured patient because there's not going to be a deductible or co-insurance. It's only a charge. But as I said, your policy has to specify that you allow that. Non-covered charges for Medicaid, as long as your provider charity care policy says it. But keep in mind, non-covered is a little bit different than exceeding the length of stay limit. They treat them differently. To be honest with you, I don't know why they decided to pick on that one little thing, that one little type of non-coverage, and handle it separately from other non-covered Medicaid charges. We've never been able to get a good answer from CMS on why there needed to be a distinction. In the end, it all gets calculated the same. It's just there's that extra reporting for it. The other thing about this is only the portion written off to charity is allowed, first of all. If some of that claim was still provider responsibility, that's not charity, at least yet. Maybe down the road, there'll be another write-off to charity, but for right now, that can be included, and it has to be during this cost reporting period that it was written off. We don't care about the service dates, other than the fact that if you see really old service dates, that really increases the risk that something is wrong, and we'd certainly scrutinize that pretty closely. But you could have something technically from 3 years ago that just now is written off for charity care, and assuming everything's done properly, it would be allowable. Courtesy discounts, which are basically for, a lot of times hospitals give it for clergy, sometimes for family, those types of courtesy discounts that have nothing to do with financial status or anything like that, those are not allowable. Physician professional services are never allowable as well. The self-pay or uninsured discount is allowable as long as your policy allows it, but it's important to understand this is not an early pay discount. If you give some sort of payment, if they pay their bill off within 10 days or 20 days, that's not allowable. Only the truly uninsured or self-pay discount would be allowable, and it has to be in your policy. Back to when I talked about the payments, I said it had to be a payment against a charity care from a prior period. If you have a payment against charity care in this same year as write-off, we don't want to see the amount in either line. It should have been netted out before the listing was created. So it should not be in charity care, and it should not be in payment. It's already gone. We talked quite a bit about the claims that have both a covered and a non-covered portion, the exhausted benefits somehow. That needs to be split. Of course, that makes the audit a little bit more complicated. It'll look like a duplicate, but then we'll find out that, hey, halfway through the claim, they exhausted benefits. So there should be some sort of documentation to show when they lost coverage and what the amount was. The insured column, again, the deductibles and coinsurance, at the first couple of years, there was confusion. CMS went back and forth a couple times on whether they would allow co-payments. Now they finally have realized that regardless of what the instruction says, it makes all the sense in the world to allow co-payments. I will say I've seen a draft of the new instructions, and fortunately they did explicitly say co-payments are allowable, so that helps to avoid confusion. Let's see, again, only coinsurance, deductible, or copay. But if you have that Medicaid length of stay limit situation, that charge amount, that non-covered charge amount, is included in this same column along with the earlier coinsurance and deductible. I know I've repeated that a few times. Just to stress, though, it can't be just in line 25. That same amount has to be in line 25 and as part of line 20. Otherwise, the calculation is completely skewed. Just like with the charges, it has to be written off during this cost reporting period. Again, if there's a payment against it, then we would not allow it. We talked about co-payments. This is a same thing. Same thing applies to both columns. No courtesy discounts, no physician or professional services. Here's the other thing I wanted to mention here. Line 20, column 2 is an insured patient, and technically it could be any insurance company. Technically it could be a Medicare patient as well. It could be Medicare that is insuring that patient. However, that should be relatively rare, because generally if you have a coinsurance and deductible that wasn't paid from a Medicare patient, generally that ends up as a Medicare bad debt. It would certainly behoove you to go through the process to report that as a Medicare bad debt. You're going to get more reimbursement out of it that way. Yes, there are those additional requirements that come into play. Like if it's indigent, you have the relatively stringent indigent requirements. You have the must-bill policy, but you're going to get more money that way, pretty much guaranteed, than including that as charity care. So for that reason, if we see a Medicare patient in line 20, column 2, It doesn't mean it's not allowable, but it's definitely going to be scrutinized. What we'd want to see is some sort of evidence that why you didn't include it as Medicare bad debt. Did you not meet the requirements for Medicare bad debt? Was that why it wasn't included? Because if it's still eligible for Medicare bad debt, and if you've met all the requirements, then there's an extremely high risk that this claim could be included here, and then maybe in a later year be written off as a Medicare bad debt as well, which certainly wouldn't be allowable. So we'd really scrutinize that scenario. And before we get into the listing, let me take a look at some of the questions here. Copay is allowed for S-10 charity, but copay isn't allowed for Medicare bad debt. If there was a copay, it should be. Now, again, the question is whether there was a copay. I don't know if there's even going to be a copay situation for a Medicare bad debt or for a Medicare patient. But if there was, it should be allowable if it's unpaid. But again, I don't know how that situation would come up. I think the copay is usually going to be for like a fee schedule type service, and that fee schedule is definitely not allowed for Medicare bad debt. HMO is not allowed for Medicare bad debt, so that might be the situation there. And you do bring up a good question. The self-pay patient with an automobile insurance as secondary insurance. So with that situation, I mean, you don't have really a contractual relationship with them per se. But if it's uninsured, if they do have coverage, I mean, there's probably not going to be a copay or deductible or a coinsurance for this automobile insurance anyways, just by the nature of how they work. I guess part of it depends on whether it was their own insurance. And even if it was, you don't generally have that for the medical side. That's usually for the collision and comprehensive. So there generally wouldn't be a co-insurance or deductible, even with automobile. So for that reason, it would generally fall under the uninsured because that's a charge amount at that point. And let's see, would we have a Medicare patient paid on a fee schedule that couldn't be claimed as a bad debt and could, yeah, very good point. So that's the one thing I want to stress here. Initially, there was a little bit of confusion in the very first year. We assumed CMS meant that no fee schedule amount would be allowed as charity care, but they clarified that it was only physician or professional services, not necessarily all fee schedule. So you're exactly right. You could have another type of Medicare fee schedule service, and that obviously would trickle through as a charity because it couldn't be a Medicare bad debt. Very good point, Tom. One thing I do want to clarify, though, or stress, I guess, is that in your books or on your books, it would have to be clearly written off as charity care as opposed to bad debt, because when we do, especially if we do a sample, we're looking for how it was written off, what transaction code was it written off through. So we need to see that it was written off as an actual charity care claim in that case. But good point. That's a great example. So now let's head into the listing. You know, some of these fields won't take too long to go through. This is the charity care listing. Insured status, uninsured or insured. We need to know that to be able to know what to expect later on. We need to know the payers, if there are any. Again, the transaction code. We want to see a charity care transaction code, something in your system that reflects this as charity care. Obviously, some patient identification. Here's the gender that I said is a little bit unusual. Of course, admit and discharge. It doesn't necessarily have to be within this period, though it should generally be pretty close. Otherwise, why was it written off so late? Inpatient or outpatient. And then here is the revenue code deal. Now, just like last year, CMS allowed us to say that if you can attest that all of your physician and professional services are handled in a different system altogether, which a lot of providers have that set up, then there's no or very little risk that your physician or professional fees would make it into this listing then they're fine with you not filling out revenue code. That obviously cleans up the listing quite a bit. It makes it easier. But the key thing is we need that attestation in the cover letter. The total charges for the claim. Now, assuming you didn't have to do a revenue code, then this is just going to be one line per claim. It's your total charges, which, again, should exclude professional fees. Date of the write-off, total patient payments for services provided. Here, I want to point out, this is all patient payments. This is not the amount that should go on line 22. This is all of the patient payments against that entire claim. A lot of those patient payments, possibly all of them, probably all of them, they were supposed to pay anyways. That's the part generally that was not allowed for charity care. So they're paying their normal bill. Total third-party payments, insurance company, whoever, somebody else paid some of the bill. The patient charity care amount. They throw in the word contractual, but it's just your charity care amount. This is basically what we're looking for as the total. This is what's going to be reported on line 20. And then there's a column S for other things, insurance write-offs, courtesy discounts, other things that are not allowable. The idea here, and I'll get to the last column in just a bit, but the idea here is that we should be able to take the total charges and these are the dispositions. Where did they go? Where did those total charges go? Were they paid by the patient? Were they paid by somebody else? Was it written off to charity care? Or was there one of these other things? The charge had to go somewhere. That's the point we're trying to make. It might have even been a bad debt. But we want to know where the charge went, and that allows us to get assurance about what amount should have been approved for charity care. The last column is that situation where you have an insured patient that had the non-covered charges for those days exceeding the length of stay limit. That's where this charge amount should go. That's one more disposition. It could be here. The only odd thing I'll mention is that T is really already part of R. It was already charity care, assuming it was approved for charity care. So this T is almost like an extra informational piece. It's basically how much of R related to this one situation. Payments, again, I think I've talked about those enough. It's just those payments against an actual approved charity care amount from a prior year. And we want to see the payments made during that year, cash basis, basically. I have an example here. It basically says he had a $1,000 charge in 2020. Only 75% was approved for charity care, so the patient still owes $250. If they pay that $250, that's not a line 22 payment. That's their normal payment that they owed anyways. But let's say they pay $850. The first $250, as I said, wasn't related to charity care, but the other $600 is a payment against a current year charity care amount. So what that means is line 20 needs to be reduced by that $600, and we don't want to see that $600 on line 22. It's a current year payment against a current year charity care charge. Both of them need to be removed. It was netted against the charity care charge. So in this case, only 150 would be allowed as charity care, and there's nothing to be reported as payment. But let's say they pay another 150 in 2021. Now it's a payment against a previously reported charity care charge. So now we're going to report this $150 payment on line 22, assuming, of course, that you kept the payment. You didn't have a requirement to refund the payment back to the patient. The payment listing, again, it's pretty similar to the other one. The amount of cash collection. We need to know the hospital charges and the physician or professional charges, because this payment needs to be allocated across both. Unless it's very clear what the payment was related to, we expect it to be allocated across both. which actually helps you. It's less of a payment you need to report. And then we want to know what year this line 20 charity care was claimed on, and we obviously expect that to be a prior year. And then how much was patient liability, how much was a bad debt amount, because if there's a payment and they had either a patient liability or they had a bad debt amount, then this payment should go against one or both of those things before it's offsetting charity care. That's the point here. Can everybody still hear me? Or can anybody still hear me? I see somebody lost audio. You can still hear me? Okay. Let me just comment to Jessica. Okay, so let's go back to, now we're dealing with line 24 and 25. I think I've covered that quite a bit. Line 24 is just an indicator. Do you have this situation with the exceeding length of stay limits? And if you don't, in fact, this is an odd example. They should not have had an amount in line 25 because they answered no. If you answered yes, then you could have that amount. But that same amount also needs to be included as part of line 20 for the system to work properly. And only this 12,000 out of this 385,000 is going to be subject to the cost to charge ratio. That's why this number, this line 21, is just a little bit less than line 20, whereas in most cases with line 2, they're going to be the same amount because nothing was subject to the cost to charge ratio. And let's see, so only payments received in the current year for prior year write-offs that were not applicable to any patient portion should be reported on line 22. You're exactly correct. And for that very reason, it is unlikely. In fact, a lot of them come through as 0. And unless we have some reason to believe through the listing that there looks like there was a payment that wasn't accounted for, 0 may very well be the right number. It just depends on your situation. So you're very correct. We already covered that portion. That's the line 24 and 25 again. And this is just a continuation of that. So now we'll talk about bad debt expense. I just wanted to stress that some of this stuff is a repeat, but it's Medicare and non-Medicare bad debts. We've already subtracted out the recoveries. Right now, there's no insured or uninsured split, although as we discussed earlier, there hopefully will be in the future to account for that weird cost to charge ratio reduction. It's also a write-off during this period. That didn't change in the instructions. That's been that way all along. And again, the payments, which are recoveries, when we're talking about bad debts, these payments are recoveries. They're already supposed to be offset against the line 26 amount. But they're offset in the year recovery. So if it was a current year payment, you wrote it off as bad debt January 31st, they ended up paying a few months later, same year, then of course, just like the charity care, it's already netted out. There's no separate line for payments under bad debts, but it would be netted out from the line 26 bad debt. But let's say you made a recovery this year against a bad debt from last year. We're not going to go back and correct last year's amount. We're going to offset it against this current year's bad debts, just like we do for Medicare bad debts. Another reminder, no physician or professional services. And now here's an important piece. We want to make sure that if you have a claim, the same amount, the full claim cannot be written off as both charity care and bad debt. It's only one or the other. However, you might have a situation where part of the claim was written off as charity care. You expected the patient to pay the rest of it. They didn't. And most likely a few months or maybe even a year later, that portion gets written off as bad debt. That's fine. Obviously, it's a little bit more risk because there's that concern about duplication. But if we piece the claim together, we'll be able to realize that in total, let's say it was a $1,000 charge, $600 was charity care, and then eventually the other 400 got written off as bad debts, that's fine. It did not exceed $1,000. That's just a simplified example. Now, I think I skipped over one of the questions a bit ago about a reversal. So if you have a reversal, let's see where I put that. I don't know where that went to. If you claim a charity on year 2, but it was the reverse of the next year. Oh, so yeah, if anytime you have a reversal, it's going to be handled in the year of the reversal. It's almost like another write-off or a negative write-off, if you will. So you can't, the whole point is we can't go back to a prior year and correct it because CMS has already used the data. So instead, we have to take care of any adjustment in the year of the adjustment. And that would be the same situation here. If you had a reversal, let's see, this case was, if the charity care write-off was reversed, which I suppose sometimes happens, I know it happens, I've seen it, a charity care write-off was reversed, you find out they didn't meet the policy, and then it gets turned into bad debt. Or what's more likely is it started as bad debt and it gets reversed to charity care. That's fine, but we're going to handle those reversals. So, you know, we handle it one way in year 1. It was, let's say it was a bad debt. In year 2, it's going to be a negative bad debt and a positive charity. You're reversing it into charity. It'll offset itself in the end, but we want to record it in the period of write-off and or the period that it's reversed / adjusted. As I mentioned before, line 26, even though they have that label, that erroneous label on the front of the cost report, it is not a bad debt expense amount. It's a bad debt write-off. That part is very clear in the instructions. So one of the things in the query logic, it asks you to do a reconciliation from the bad debt write-off you're reporting to the actual financial statements or trial balance to the bad debt expense. The key thing is that these are very, very unlikely to be the exact same number. And if we see the same number, that's we'd be asking questions there.
Okay. Yeah.
Whoops.
So.
Okay. Muting everybody. I'm not sure how they're getting through though. Let's see here. Somebody's taking themselves off mute. Let me mute it again.
Talking about, you did mention this is the prior.
Someone's off mute somehow. Mute all button does not allow me to mute this person. I don't know who it is. Let's see. Try that. See if that works. So the reconciliation here, I'm not going to spend too much time on this example.
Mm-hmm.
It's in the actual query logic questionnaire. It gives you an example to use. We're basically starting with the financial statement data, and we want to eventually get to the write-offs, and they're basically a derived number. There are other ways to do this reconciliation.
Okay, so
someone's off of mute.
The thing it happened in the 2017 audit.
I don't know who this is. I can't mute them, whoever it is.
Okay,
shoot. Let's see here.
Agency to see what exactly they see concern.
This is very weird. My mute all button does not mute apparently all. I can find out who it is. Whoever's talking on the, looks like on the phone maybe, can you put yourself on mute?
I identify the situation already to kind of like worry. No, so technically in the prior year audit, it no impact, right? They have some concern, but no impact. Okay.
Try to go ahead. I don't know why I can't mute the person. Okay, where were we? So line 26, the template basically. Most of the template's the same, except toward the end, we're starting to deal with the we still have the same thing. We have the revenue code total charges. We're offsetting patient payments, offsetting third-party payments, offsetting all the same things.
Yeah,
Now,
the
the difference is somebody on the phone. I don't know if you can hear me still, but we're hearing you. I'm not sure how. Can you mute yourself?
Okay.
Thank you. So we have so basically we had all these offsets to the charity care charges. We have the revenue code total charges, and we're offsetting them with the payments, the third-party payments, charity care, contractual amount. That's the thing I want to point out here, is that this is basically any charity care that's ever been written off for this particular claim, regardless of the year. So this doesn't necessarily have to tie to your charity care listing from this year. There might be a string of charity care amounts that have been written off for that person, for that claim. We're just trying to figure out of these charity care charges, how much is reasonably left as a bad debt write-off amount. That's the point here. And next topic was the importance of charity care and financial assistance. So in this case, we already talked about a lot of examples where it had to be included in your charity care policy. If you look at the cost reporting instructions, it very clearly says that multiple times. And these are also part of CMS's required audit steps. The reminder letters initially went out a couple of years ago, September 18th, because CMS brought this up. They had a big concern about this. So by now, hopefully every provider has had a chance to adopt those changes, update their policies. You know, we've been able to give a little bit of leeway up to this point with just management recommendation letters that, hey, you need to change the policy. But at this point, we're getting into the years where those policies should have been changed by now. Some of the providers, their entire fiscal year end would be covered by, it's after 9/18. Other providers, maybe half and half, just depends on what year you have. So we may be making adjustments for these this year if we still don't see your policy updated.
I don't, but I can get it.
Just thinking if we could look at, say, reports.
Let's see, adjustments will, as I said, adjustments will start to be made for this year if the policies were not updated. The link here is, everybody should have the slides so you can click on the actual link. This takes you to the templates from our website, and it includes the query logic questionnaire as well. One of the later
part-time, and you and me.
It looks like we're still hearing somebody come through without mute. Can you put yourself on mute? For some reason, I'm not able to.
No, you want to go part-time. I want to go part-time. So
hello, can anybody hear me that's talking? You're not on mute.
Work on the bad debt. If you find someone on a bad debt.
It's odd. I cannot see who is talking. Nobody looks like they're talking. It must be a call-in, but it's not in the list. Hopefully that stops it. But you'd think the mute all button would mute every single person, but apparently it does not. Back to file exchange here. So this was previously known as Secure EDI. You'll still hear some people refer to it as Secure EDI. It's based on what's called Move It. That's the vendor, that's the platform it's based on. The file exchange has the same design as the old Secure EDI. The only difference is now you have a new account for it. So to request the setup of the account, if you've not used the new file exchange yet, just like before, you just need to contact the auditor that you're dealing with and just send them a regular email, and they'll respond with an initiation email through file exchange, and then they'll send you your initial password.
Yeah.
And now if you do want to send information to multiple auditors, each one is going to have to send you an email first. It's you need to be set up by each person, by each auditor. You won't need a new password every time. You'll just need an email to start the discussion. And here is the link to that new one. It is fe.ipsic.com. It's FE stands for file exchange, essentially. And the instructions are available on the website. In fact, I have a screenshot here. You'll notice now it's calling it file exchange. Everything else is pretty much the same. You know, one of the problems with that is that it does have a relatively quick expiration period. It's unfortunate. It's they had to be, since it's open to pretty much everybody, and it's obviously likely to be PHI data coming through it. The requirements are quite high, and they can't have any accounts out there that are inactive. So if somebody's not using it for about 30 days or so, then it does expire. The good news is setting it back up is pretty easy. Just get with that auditor. All auditors have access to set the accounts up and change your passwords. The other thing, kind of a special point here, the amended cost reports. This is something we've talked about in the past, that once the S-10 audit process begins, which we're going to peg as 3/1 of this year, we're not able to allow any sort of amended cost report coming in after that point. Now, there's only one exception that CMS has allowed. There was a big discussion, a big work group with a variety of CMS officials, some provider representatives, some consulting firms, talking about when an amended is really necessary, when it should be allowable. And the response was that the only exception, the only time we are absolutely required to accept an amended cost report is for a revised Medicaid day listing. And they decided 1 year after the initial due date is allowable for that amendment. Other than that, though, nothing is required to be accepted, and it's up to the audit. It's up to the MAC, essentially. In discussions with MACs and CMS, we've decided for these situations with S-10, it introduces far too much risk and far too much rework to allow these amended cost reports to come in after we've already started the S-10. So if there is an S-10 related change, like you're updating charity care or the total bad debt number, this is something that you should work with your S-10 auditor to incorporate. If you weren't able to get an amended cost report in, for example, prior to 3/1, prior to the cutoff date each year, and again, it should be early in the process because the assignment, the scoping, the work papers, they're all developed based on that initial amount of line 30 and by the initial amounts of line 20 and 26. So when they change throughout the year, it causes rework and it causes risk. After the S-10 audit is done, there are no direct S-10 audit adjustments allowable. We've already audited the data. We've locked it in. We're not going to allow those numbers to be changed. But furthermore, nothing else that indirectly impacts line 30 will be allowed. So even if you're not updating line 26 or line 20, let's say you're just updating worksheet A8 adjustments or some stats on B-1 or some costs on A that we didn't audit during S-10, they still impact line 30 because they impact the cost to charge ratio on line 1. We are not allowed to accept the amended cost reports. Of course, those numbers may very well be changed through Wage Index. Wage Index takes a look at some A6 reclasses quite frequently. That could adjust the cost to charge ratio and line 30. And of course, at final settlement, quite commonly the Medicare bad debts themselves are adjusted, but there might also be other adjustments made that impact line 30, and that's fine. The difference is that these are subject to reviews. Wage indexes and final settlements, we're reviewing the data. We can't just accept an amended cost report and blindly let it go through and change the line 30 amount. That's really what it boils down to. I will say, however, that it depends on the scoping during the review. So for example, final settlement, you're going to need to work with that final settlement auditor, that desk review auditor, to see if it's something they can accept at that time, if it's something they can scope during their normal desk review. And if so, then they can incorporate it at that time. Of course, the best approach is to get it, obviously in a perfect world, the very first as submitted cost report would be 100% accurate. But if you have an amendment, really get it in as soon as possible before that cutoff. That'll be the cleanest way to handle it. Some special points continuing, duplications of claims on listings. So we have a big part of our audit review is looking to see whether that same claim shows up either more than one time in the same listing or across listings. So maybe it shows up on the bad debt and the charity care listing, or maybe even it showed up in the prior year charity care and the current year charity care. That's a big red flag. We need to take a look at it and see, has this claim in total been written off more than what would be allowable? Like I said earlier, you might have a situation where part of it was written off as charity care, and then the next year the remaining part is written off as bad debt. Or you might have a situation where there might be 2 years of charity care, half and half, and those would be fine. We'll flag them, but then we'll be able to tell through our analysis that, hey, in total, if you had $10,000 of total charges, the write-offs didn't exceed $10,000. The write-offs and all the other elements did not exceed $10,000. So that's the thing there. Then we talked about sampling a little bit. In a perfect world, we'd be able to address all of the errors prior to the detailed testing, prior to the sampling, but there might be situations where just inaccurate data on the listing or something we couldn't clearly identify up front, that becomes an extrapolated error rate, an error that we have to extrapolate. And let's see. Oh, when we determine a required sample size, we also select a few spares, because chances are when we validate the sample, it's going to come back and say, well, you need 1 or 2 more units. That's just generally whenever we make an adjustment based on errors we found, it's probably going to tell us, hey, you need another unit to support this confidence interval or precision level. And it just tries to minimize multiple requests. We're not going to ask you for 50 extra spares or anything like that. Usually it's about 5 extra spares just to be on the safe side. Or at the very least, if you have the data ready, you don't necessarily need to submit it, but have it ready. We just don't want to come back with you and have a surprise request for you, basically. Let's see, special points. Some of these are repeated now. The charity care, again, you might very well have a split claim, and part of it's insured, part of it's not covered. The charge portion goes to column 1. The deductible, coinsurance, copay goes to column 2, unless it's that Medicaid length of stay issue. In that case, the charge also goes to column 2. Bad debts, I think I repeated this before as well. Two different things. First of all, again, some of those Medicare bad debts that are on line 26, line 26 has to be Medicare and non-Medicare. Don't just report non-Medicare and then expect us to take a Medicare bad debt listing that you filed and add it, because again, that Medicare bad debt listing may not actually be the amount of Medicare bad debts that need to go in line 26. Maybe some of those were written off of your AR in a prior period. So we need to see a full listing showing Medicare and non-Medicare write-offs during that cost reporting period. So we've seen that in the past where some providers just said, hey, here's the non-Medicare. I already gave you a Medicare bad debt listing before. We cannot add them together. They're not necessarily the same period. Payments, again, we think we've hammered that down quite a bit. And here is a new piece that we have, and we'll talk about it when I look at the questionnaire in just a few minutes. The HRSA Uninsured Provider Relief Fund payments. This one, CMS came out midway through the audit last year, and they required us to ensure these were carved out, because the idea is this HRSA fund covered certain claims. So if that particular patient was covered by that fund, then they don't want to see the charity care. They're not going to give you a second reimbursement as charity care or as bad debt. So we'll see that in just a bit in the query logic questionnaire. the available resources, again, the website, our YouTube channel that includes, this is where we'll put the recording, by the way. It'll also be loaded on the website. That includes a lot of our audit topics. We just had a new one put out there recently as well on the ESRD high discharge add-on for those that it applies to. Our template link I already showed you earlier, and we will see the initial request letter in just a few minutes. Before we get to the questions, I'm going to look through the questions, and then we're going to open up the actual query logic questionnaire and talk about that for a bit. So let's see. Oh, there's another call coming in. Oh, that might be someone's calling in and maybe to the wrong number. Okay. So that's, hopefully that's eliminated now. And all providers were supposed to get management letters per CMS, or was that something WPS decided to do? So it's something we actually talked about with all the other contractors. So there should be a lot of consistency there. All contractors were notified that these charity care issues, the fact that it has to be in the charity care policy, that's an absolute requirement. Some of these things, by the way, come through our various quality reviews that CMS performs on us. And whenever we have these types of findings, we address them in our MAC work groups so that all MACs are aware of what CMS is expecting, any changes that come up in those expectations. So I definitely would say all MACs should have been doing this, or whether they call it a management letter, whether they're doing some other notification, but they certainly should be notifying all the providers because they need to be making the adjustments. That's, I guess, what it boils down to. And yeah, Angelo, that's correct. If the provider has a DISH Medicaid Day update, those amended cost reports can come through as long as it doesn't have something else that impacts S-10 or the cost charge ratio. But if it's a pure Medicaid Day adjustment, we are required to accept those within 1 year. So that one can come through even if the S-10 audit has started. And let's see, how can this allowable bad debt and charity be determined in the listings? Oh, you're probably talking about the total amount, maybe. So what, let me go back to the listing here. The bad debt that we're looking for is going to be right here. There's going to be a total at the very bottom, a total column. And column S would be what we're looking for the bad debt. Now, again, this charity that's reported on the bad debt listing, that's all of the charity that's ever been applied against this claim. So it's not going to match up necessarily with your current year charity. It could, but chances are it probably relates to a prior year as well. And the other one is going to be, it's an odd name to it, and it's right in the middle. I'm not sure why that was put there. Where'd it go? Oh, this is the payment, I'm sorry. This one, it's the patient charity contractual amount. Really, I think that would have made more sense to be at the end because that's ultimately the number we want. That's going to be the one that goes on S-10 line 20. And yes, you're correct. So Jonathan, are you saying that after 3/1, the cutoff date, we cannot amend Medicare bad debt, for example, because the audit has started? But then even once the S-10 audit is complete, the point here is that we're not going to be able to allow your really informal amendment where the amount's just allowed kind of blindly. You have the ability to put it in your as submitted cost report, and then we scope it. We potentially do some level of review on it, a desk review. But that kind of temporary acceptance is not going to be done for these bad debts. If bad debts come in later, it has to be scoped for review, or at least it has to be able to be scoped during that desk review. So we cannot allow the amended cost report anymore. That'll definitely impact line 30. In fact, it impacts line 27, 27.01, 28, 29. It impacts all of those. So the point is, if we allowed that through, then there's a risk that this unaudited information that impacts line 30 that could have very well impacted the scoping of the audit, that it's allowed through after the audit. And that's one of the risks, is that somebody slips some information in later and now it's not going to be audited by the time we send the line 30 data on to CMS. It could have changed potentially the scope. But the other risk is, that since now we have 2 or 3 or 4 iterations of that cost report, there's a risk, and it has happened in the past, and there's a lot of rework related to it. There's a risk that the wrong file gets paired up with the wrong adjustments and sent off to CMS, and then we have to come back and we have to rework it to figure out which one was the correct one. But another thing is, when our work papers are created, they're usually, some of them are created through our forms early on in the process. When we do our reconciliation, we have to create work papers, and all of that's done based on the cost report that we have at that time. So if all of a sudden a brand new one comes through, there's rework. We have to go back and redo all those work papers, reconcile everything. And with such a big workload in a short period of time and a drop dead date, it's just extra rework that we cannot handle. We can't take that on, and we're not required to. So that's the point there. So you are correct that those amendments won't be allowed. And again, that should be consistent across all the MACs, because we had a pretty lengthy discussion with all the MACs, with CMS about this, about the trouble that allowing these types of amendments could create. So let's see, in the same service period, yeah, I think we covered that piece. The HRSA payments. So if the patient had a COVID test reimbursed by HRSA for $70, if they documented that as a third-party payment, but the total charges on the account were $1,000, and the patient qualified for a $1,000 charity. So I think the problem here, though, I'm assuming the total charges related to some other aspect of the claim, some other service altogether. If that's the situation, then yeah, that would be the case. But if there were any other charges, if it was just this COVID test and the charge was $1,000 for that COVID test, acceptance of that HRSA fund payment, it was full payment. It was intended to be full payment for it. There's no balance billing for that. There's no other billing allowed. So that would write off the entire amount at that point. And that's what CMS was stressing to us. But if it was a claim that had a lot of other things that accounted for this remaining $1,000, then yes, that would be fine to include the remaining $930. But if it was $1,000 just for the COVID test, the entire thing is gone at that point. That was one of the requirements, or one of the contingencies of that HRSA fund. So we got that one already. And that they couldn't submit an amendment for 2019 during the dish. So yeah. Oh well, shoot. Did you submit the listing? Did you submit the listing at all? I guess you at least submitted it, and it was rejected for the dish. So that's an unfortunate part there, because yeah, if you submitted it, then there's proof that you had a revised listing. Yeah, we could accept that at that point. In fact, the thing about the 1-year requirement, that's just how we're required to accept. That doesn't necessarily prevent us from accepting it beyond that if there's some justification, and this would be good justification for that. So that would be perfectly fine in that case if you want to resubmit that. Yeah, so what you heard was on the bad debt listing, there's a charity care column, because we're trying to figure out where did those charges go before they ended up as bad debt. That particular charity column would be charity care for those claims, regardless of what year was written off as charity care. But for your actual charity care listing, it's only those written off that period. So it's kind of the weird part. This is your charity care listing that I'm showing right now. These are only the ones written off this period. But then when you get to your bad debt listing, this number right here, this number, this charity contractual amount, this represents for these particular patients, how much charity care did they ever have approved? Because we're trying to back down to figure out what the write-off, what the allowable bad debt is. And yes, yeah, the automobile insurance, you're correct. If there's no deductible or co-insurance, then it's going to be considered insured, regardless of whether it was primary or secondary. Well, actually, let me back up there. If it's secondary, if there's some other insurance company, then there would be a deductible or co-insurance covering it first. And in that case, the claim, at least that portion of the claim, would be insured. But if there were remaining charges that were covered by automobile insurance, that would be one of those split claim situations. Those charges weren't covered by the main insurance company, so they can't be considered insured, but it could move over to the automobile insurance. It could move over to uninsured because it's going to be a charge amount at that point. Now, again, that assumes that there was no deductible or co-insurance or copay, which for automobile insurance there usually would not be. It's just a charge amount they're paying. The whole point is we only want to subject charges to the cost charge ratio. We don't want to subject deductibles and co-insurance to that. So a lot of good questions there. Any additional questions before we open up the query logic questionnaire just to talk about some of the key points before we wrap up for the day? Okay, well, so we have, again, this template that I had included in the email that went out, and it's also on the website. We have all the templates we just looked at, the charity care, payments, bad debt, but then, and there are some instructions, but we also have a questionnaire. Now, most of this has been around for a couple of years now. We broke it into sections, charity care. It's basically going step by step, talking about a lot of the things that I've already mentioned throughout this training. We want to make sure it was written off this period. So how did you ensure that? How did you filter your listing, or what did you look for? How did you ensure there were no duplicates? What transaction codes do you use for charity care? So what should we look for? What methods are used to ensure there are no claims reported in both the charity care and bad debt listing? Of course, unless it's a split claim. The line 20, or Medicare, do you have any Medicare charity care amounts? And if so, explain why they were not written off as bad debt, Medicare bad debt. Does your policy allow exhausted benefits? Does your policy allow non-covered services? Because again, as part of the audit, we need to look at the policy before we can allow that amount. Here's the non-contractual relationship. Do you have that in your policy, and how do we find it? Medicaid length of stay limit. Do you allow self-pay discount? If so, then it can be allowed. How did you ensure there were no physician or professional services? All of those were the same. How did you ensure there were no, yeah, we just said that one. And here, number 12, this is the key thing. As far as duplicates, we take a look at that total charge column, and we expect that to be equal to or more than the sum of all those other component columns, the total patient payments, total third-party payments, charity care, other contractuals. The sum of those components can never exceed total charges. That makes no sense to have more components than you do a total. However, they may not equal total charges. You may have $900 of those other components and $1,100 of total charges. That just tells us that, hey, there's still $200 out there that the patient owes. They haven't paid it yet, but it hasn't been written off as charity care or bad debt. There's no problem with that. We don't need to know about that yet unless it's eventually written off to bad debt. Here's one that I added a comment to. If you have any patients that were included in the insured column, but they don't have any third-party payer or third-party payments included, explain why this might be. Certainly if they don't have any third-party payers, then how are you calling them insured? It's possible they don't have any third-party payments if they haven't met the deductible for the year, especially with high deductible plans. It's very possible. And presumptive eligibility, you can use for charity care. You cannot use for Medicare indigent bad debts, but you can use for charity care if your policy allows it. In other words, you're saying because they're eligible for some other program, now you're determining them eligible for charity care, or maybe you're just taking a look at the federal poverty guidelines and using that. That's perfectly fine for charity care as long as your policy allows it. And here's that point to answer that question you had earlier about the HRSA. For cost reporting periods with fiscal year ends 3/1/20 or later, has your facility received any HRSA-administered COVID-19 payments? Under the terms and conditions of the HRSA-administered program, payments are considered payment in full for such care or treatment. So if you have received any payments, how did you ensure that any corresponding patients or claims were not included? So if that $1,000 example from earlier, if it was not, if the $1,000 was entirely for the vaccine or the test, I guess, and you only received $70 in payment for that test, that's full payment for that $1,000 thing. You cannot allow the other $930 as charity care. Payments, nothing really different there. Just explaining again what we've hit on with the payments. Bad debt, I just really wanted to stress again with this note, I added this year, that the line 26 has to be both Medicare and non-Medicare, and it can't just be a separate Medicare bad debt list from E-Part A. We need to know when they were written off. And line 20 really hits on that. Were there any Medicare bad debts reported on line 26 that are claimed in a different cost reporting period for Medicare bad debt reimbursement, E-Part A, E-Part B? It's quite common that this will happen, and we just wanted a little indication of it if that happens. You don't need to list every single one out or anything like that. Ensuring there were no duplicates across current and prior year, transaction code for bad debts, and here's that reconciliation for bad debts. The HRSA impacts the bad debt line as well. And finally, just a couple of additional overall issues. If the listings do not correspond to the amounts you originally reported, let us know what changed, why it might have changed. Again, if you have an amendment, you can submit the revised listing. Just do it as soon as possible so they can start their audit with the proper data. Certainly before they do any sampling, we wouldn't be able to accept a revised listing after they start the sampling. And then any other explanations that you think might be helpful for the auditor. So let's see here. Let me take a look at some remaining questions. The audits are, they're expected to begin really, if one provider submitted data today, then it very well could start. It probably won't start quite that quickly, but yeah, by 3/10, we expect at least a few of the audits to be going, whatever providers have submitted the data by that point. And let's see here. Nancy asked a question about whether auditors should be sampling reversals. I think the answer is that if there was a reason, they have to. Think it is a risk area, but it's unlikely. So it really just depends on the situation. It's not a guarantee that we'd sample it. As long as the reversal was handled properly, so it was negative in one listing, positive in the other listing, then there's certainly less risk there. If we saw a lot of them, or if we had questions about them, we might just either ask the questions and hopefully get assurance that it was correct, or we might need to sample it. Just may not be that likely. And so the templates themselves have not changed. The questionnaire, though, that should be out by Monday. I put it through our website area, and I think Monday or maybe even Friday. They might even have it out by Friday. Just kind of depends. you'll see the updated questionnaire. However, I did send the updated template to everybody through the email. So anybody that received an email with their initial request letter, that is the updated questionnaire. And you'll see it on the website most likely by Monday. Okay, we have another, looks like a minute, but we can take a few more minutes if anybody has any additional questions that you'd like to ask for the session. Okay, and like I said, I will be sending out a revised email with the same attachments just to make sure you got them, but also it'll include a link to the YouTube video once it's ready to go, and it'll be on the website as well. So I thank you all for your time. We'll be having another webinar probably in about 2 to 3 months, depending on what topics we have by that point. It most likely won't be S-10. It'll be other audit topics. We try to do those around 4 times a year, kind of quarterly. But I thank you all for your time, and have a great day and a great week.